thank you, Dodd, and thank you, Peter, for joining us here in our show, Get Think Tanked, or actually it's Think Tank Exchange. Sorry about that. Dodd, like I was saying, you and I go back 20 years, and you've done just a ton of great research in the ETF think tank. You're very well known in that regard. And Peter, you've been at Davis Advisors for 25 years, portfolio manager. And when we've spoken candidly, you've helped ground me because you've got a long-term view of things. And I think at the end of the day, that's what people need to be thinking about. As much as we talk about how past performance is not indicative of future outcomes, right? Or future performance, we're always looking forward, not backwards. And I think way too often people forget about that and they treat it as just a matter of disclosure, but it's much more important than that. One other thing before I forget, it is Wednesday, and Dodd, maybe you can touch on exactly what Wisdom Wednesdays is all about at Davis Advisors.
Yeah, we just entered the social media space through LinkedIn and Twitter. And every Wednesday, we do a post under the hashtag Wisdom Wednesdays. And it really just shares some insightful wisdom, whether it be a quote, a graph, just some insight on giving folks perspective on the market as it exists today, and to try to really ground themselves in terms of what we're all trying to accomplish here, which is to grow wealth and to do our very best with our investments. So a lot of the Wisdom Wednesdays is really intended for advisors to have deeper, richer conversations with their clients, and many have used them for their newsletters and what have you. So glad to be on social media finally. We'll be including things beyond Wisdom Wednesdays, but to really get the ball rolling, every Wednesday we have a thought-provoking, interesting quote that or insight we're sharing on Twitter and LinkedIn.
So, here in the ETF think tank, we're very much all about research, right? Of course, I always talk about how structure matters. Given your background, Dodd, I will start with you in research. Why do you think everybody focuses so much on the S&P for performance?
Yeah, well, Dan, talking to the professor and somebody who writes under the umbrella Structure Matters, this, is very, I think, close to your heart. The S&P started 95 years ago in 1928 and has gone through this evolution, right? To your point, it was intended to be a yardstick, a benchmark representing an opportunity set. And when you think in 28, there were only 90 companies, and 58 it expanded to what it is today, the S&P 500. Yeah, it's to represent the leading companies, generally the largest companies in the U.S. equity market. But we've seen things really morph, right? It's not only become a yardstick, but it's actually become kind of an investment process or philosophy. And I think folks need to look under the hood and understand, what are the rules? What are the considerations in the case of S&P, where it's decided by committee? And it is semi-active, right? We see about a 5% turnover historically, 22 changes per year. But what is really driving that exposure? And I think the thing that really kind of hits me when we were preparing for this is you take a step back and look at three of the indexes that are talked about all the time on regular media, financial media. So S&P 500 is up roughly 10% year to date. The Dow Jones Industrial Average is flat. It was down at the end of last week. It's up slightly now. And then you look at the NASDAQ Composite, let alone not just the NASDAQ 100, and that's up about 25%. So, what are we doing? Are we up 25%? Are we up 10%? Or are we flat? And certainly it's been concentrated markets. And it's been interesting for me, and it's a real luxury to have been an evangelist for indexing and have really kind of gone under the hood on indexes. But there are some limitations. Is great in the benefits that indexes like the S&P 500 provide, such as broad diversification, exposure to major industries and in the largest companies. We, from an active lens, look at it very critically, I think, as every investor should. And we've got a few concerns. One is bigger doesn't necessarily mean better all the time. The second is certainly when you get to the heart of the strategy being market cap weighted, it's really incenting people to allocate more money, not only to the biggest companies, but the companies that have appreciated. And we all understand that lower prices increase future returns, higher prices decrease future returns. So it's kind of a bizarre strategy from that perspective. In this environment, like several others, we see a lot of concentration, and that's a concern too in terms of unintended exposures. In the S&P, and Peter will talk about this, is just so concentrated right now, and it has been in different industries and different companies historically. And just to be aware of your exposures, because you're not necessarily getting that broad diversification that you think you're getting. And the final thing is, I think in a market where the rising tide doesn't rise all boats, what you don't own is as important as what you do. So those are kind of the ways you can kind of poke holes in. It's a finely constructed index. It's a great opportunity set for people. And for many, it's a great way to invest, but we see greater opportunity being able to, take a deeper look and exploit some of those things that in this environment, we see enormous opportunity.
Peter, please offer up your wisdom. It's Wednesday, and add to what Dodd was talking about. I'm very concerned about it.
Well, I am. I'm concerned that we have limited history in our sort of in our mindset looking forward. And I know that sounds like a bit of looking at past performance to judge the future. But what I mean by that is it's been a long time since the S&P did not perform the way people expected, right? In other words, it's become sort of it's become an expectation that it can beat active management all the time, or in the vast majority of cases. There are interesting phenomena back in the past of the S&P where there have been whole decades or 2 decades at a time sometimes where the S&P has failed to beat a lot of the active managers and failed to produce sort of decent returns relative to inflation and such, and the risk-free rate. It's just been a long time since that's happened, right? But over the very long term, the S&P 500, like the Dow, has been moving up sort of in a staircase-like fashion. It has very long phases. So taking the Dow as an example, because it was a primary benchmark, decades or a century ago. When Chris Davis's grandfather started investing in the late 1940s, the Dow was about 200. Then it went up 5-fold to 1,000 intraday in 1966. Now, from 1966 to 1981, there was a rocky ride, right? You had a bear market, severe bear market in 73, 74. You had an energy crisis or two. You had, massive stagflation. Well, what happened was from 1966, when the Dow crossed 1,000 for the first time, it actually didn't break through 1,000 again until 1981. And that is the kind of but the reason for that occurrence is because the Dow became so concentrated and the S&P too, in the Nifty 50 companies, right? So this very, very concentrated, super large cap, must own the biggest companies mentality at any price, at any cost. And it was really disastrous because all you got on average was the dividends for that sort of decade and a half. Then from say 1981 to the late 1990s, we saw the Dow rise, what, 11-fold thereabouts. Well, the interesting thing is when the tech and telecom bubble burst in 2000, from the year end of 2000 till about 2010, I think the Dow went from about 10,700 to about 10,700. There was sort of a lost decade in the Dow, at least. And so the reason I bring that up is simply because it's not a foregone conclusion in my mind that this pattern of sort of this undulating, almost accordion-like trend or dynamic between concentration and breadth in the index, there's a certain cyclicality to it. In fact, it just goes over very, very long time scales. What concerns me today about the S&P 500 is not necessarily some of the rules such as, well, never cut your losers, things like that. That generally has been, I think, a good thing for the index, but rather the valuations and the accumulation of capital at the very top of the index, right? So NVIDIA, for example, has been in the news with AI and the AI craze. NVIDIA, by my math, is at least 84 times earnings. Okay, is at least 84 times earnings. Apple is probably about 30 times earnings. Microsoft, which we love, but have a much smaller weighting than the index, is about 34, 35 times earnings, right? You can get into other names like Amazon and Tesla. There's some companies where you can make some mitigating adjustments, but by and large, the top sort of 7 performers of the index in the tech industry has been powering the entire 10% return of the S&P 500. That is why, Dan, I don't feel like it's necessarily a bull market, because for most of the 500 stocks in the S&P, it has not been a bull market. It's been a sort of a 1%er year-to-date return, right? So,
yeah, you covered a lot right there, and one of the things that everybody has to contemplate, right, is the influence of stocks like Apple, which candidly is also a growth and value stock in both indexes, right? I mean, how confusing is that, right? Is this a market for value or growth? Well, if the biggest name is influencing both indexes, what does that mean about the marketplace? Like, what should investors be thinking about in the context of the structure around indexes these days?
I think the first thing you should consider is you should be agnostic at the outset as to which portfolio strategy or process you're going to look at, right? Active, passive, and everything sort of in between. And the reason you do that is because on a prospective basis, ask yourself, what portfolio do I feel as a fiduciary is the responsible way to allocate capital? The truth of the matter is passive investing gets a pass half the time, okay, more. In other words, people just assume that because it's passive, it will therefore work. And what I would suggest is the passive index has not looked this way since the late 1990s, which led to sort of a lost decade thereafter. Which didn't look that way since, say, the late 1960s, early 1970s. And each time we've seen this very, very acute concentration, highly, highly valued stock, we have seen, I think, not just underperformance in the aftermath, but sometimes, like after 2000, I mean, we had 3 consecutive years of almost double-digit negative returns in the S&P. That was brutal. So I think that that's really a choice that we have in front of us. You don't have to go all active and you don't have to go all passive, but just like stocks in your portfolio, depending on valuation, sometimes the S&P is good value by and large, and sometimes it's not. I think the way it's currently constituted, it's probably skewed and weighted as such that very few active managers would get hired if they actually had a portfolio that looked like that,
Oh my God, that is the key question, right? If you looked at the S&P 500 as a fiduciary, right, would you really allocate it to it, knowing that it's up against law of large numbers right now?
That's right.
Yeah.
That's right. Yeah. Yeah, I mean, I think for the S&P 500 to be averaging on a forward basis, let's just say 21 times, and we take say a portfolio like ours, like the USA, for example, where we have much more of a moderate balance in terms of the distribution of weightings, right? The portfolio that we have, which has some names in common with the S&P 500, well, we're trading at about 12 times forward. The S&P is at 21 times forward. Now that should not, usually I don't see that kind of delta, okay, that kind of differential. And it doesn't suggest, it suggests to me on the one hand that, you know, we have things that probably are in some cases underestimated, but it makes more of a statement about where the S&P is structured right now on a market cap weighted, size weighted basis. I don't think size times super high valuation is going to bail you out if you enter a long period of time where basically stocks have to wait and digest, right? In other words, the companies will have to sort of grow their earnings into their current multiples. And I've seen long periods of time where that could be absolutely dead money. And goodness knows, if you have a shock or an event in the course of that type of environment, you get doubly penalized, right? So because you have no margin of safety. And that's my concern with people, with people just sort of going into indexing without thinking about sort of what the environment was during which indexing did so well versus where we are starting today. And based on that, what is the outlook for the index? And like I said, it's a good exercise to step away and pretend it's not the S&P 500, but that it's an active manager's portfolio. Would you allocate to that manager? Would you keep allocating to their highest, most appreciated and highest valuation names as they got bigger? It's an interesting truth test, right? As to what your belief system is in the markets. And I think there's a lot of institutional imperative to own an index because it's the index. But I also think that, you know, just like people, sometimes, you know, you get long in the tooth in certain phases of your career or your life, things change. And I think the S&P could change.
Dodd, do you want to add to that?
Yeah, I mean, maybe we go a little bit into kind of what has changed and why. And I think a lot of, you know, folks base their decisions on the past. Our biases are anchored in our most recent experiences and environments that we've been in. And we're coming out of an extended period of time where rates have never been as low on the long and the short end. Money's been free. It's been easy to lever up as a company. It's been easy to do private equity and venture capital deals, disruptors. It was the perfect environment there, and in durability and strong balance sheets and conservative ways of running companies and conservative credit cultures in the case of banks, maybe wasn't rewarded, but that's changed. You know, rates are far higher, and I think a lot of us would agree that they're probably not going down to where they were before, and if they do, we're in a lot of trouble. So you're looking at valuations, I think, that are still based on you know, people having experienced abnormally, unsustainably low interest rates, and the environment's changed, yet valuations haven't. And we've seen such a divergence in stock prices versus business results, or if you want to put a real number on it, you know, earnings. And you know, we have a lot of examples of that within our portfolio, and it's frustrating to see. But you know, over the last 10 years, we've seen the earnings grow in our companies as a proportion of you know, their contribution to S&P 500. Yet their valuations have dropped. And the exact opposite has happened in a lot of businesses we haven't owned, where, what was it, Peter, 2020, we were looking at the end of the year, there were 73 companies that were trading higher than 10 times sales. I mean,
That's right.
That number alone makes you just, you know, how do you get a long-term return on a company you're buying at 10 times sales? I mean, a lot of stuff has to happen for that to end well. So,
you know, years ago, I think it was 99, I'm pretty sure it was, I was having dinner with Seth Klickenhaus, is probably somebody, Peter, you recall. And his comment in 99 to my question of, aren't you excited? How does it feel to go through 10,000 on the Dow Jones? We were at 10,000, right? And now we're in the 30s, right? And his comment was, the first time you go through is exciting, but the next time you go through is even more exciting, right? A lot of wisdom with that statement, I think, unfortunately.
Yeah. One thing I'll also point out is, in terms of these effects, these distortions that occur, it's not just the U.S. market. It is something that happens on occasion in lots of different markets. Okay, so during the .com and the TMT bubble, the Toronto exchange, where most of the Canadian pension funds assets were required to be in Canada at that point. Okay, the Toronto exchange had, I think, a 20% weighting on Nortel networks, right? That's how large it got to. And then if you think about the extreme scenario, bear scenario of what I'm describing on the S&P, remember that where was the Nikkei, right? Where did it peak in 1989? It was like 37,000 almost, right? And I think it's like 31,000. I mean, this is 33, 34 years later, something like that. I mean, that's kind of crazy, right? So it can happen, and it can happen to indexers, just like active managers have some risks. And I hope that the risk of not following suit, not sort of the risk of looking foolish and out of step by not owning the index, I hope that people are not sort of overly persuaded to just keep riding a school bus off a proverbial cliff if that occurs.
So basically we're dancing around an issue here, around Apple. Okay. And my concern is a bit that you got Apple increasing its buyback, 90 billion after buying, I think it's like $600 billion, or maybe it's 570 billion. When you get to such large numbers, it becomes ridiculous anyway, right? How is it that a company of its size can continually buy back its stock and justify it, knowing that, well, its earnings actually may be flat or even declining on a go-forward basis? And what are they really accomplishing by buying back their stock? I don't know who wants to take that. Peter, you maybe go first with that.
Sure. Well, I think that my feeling with respect to a lot of the tech companies that buy back stock, the cynic in me back in the 90s would have said, oh my goodness, all these companies are just buying stock to essentially mask how much they're diluting us otherwise in terms of options granted, right? So part of me always is a little suspicious in that regard. But at best, you do have to ask yourself at sort of 30 times, what is the merit of this? And a lot of people don't know the math, but the way I think about it is you get your earnings yield. So if you invert your PE, so that's about 3.3% earnings yield currently. And then you multiply that times the return on equity of the business, because basically that's what you're doing. You're buying it at today's current yield times the internal sort of reinvestment rate. And you would need to have fairly heroic compounds in that reinvestment rate for a while. I think Apple is still within sort of striking distance of that, but logically and rationally speaking, it could take 2 to 3 years before it becomes sort of a rational decision to be buying back shares at this level. It reminds me a little bit though of Michael Dell back in the late 90s when he was buying back stock, and he was parading around talking a lot, and he's buying back stock at 40 times earnings, right? 2.5% earnings yield. And then the business fell apart eventually. So that's the risk, that it just becomes sort of lost capital, right? Just lost money. And I think that is also a reason why you have to be somewhat skeptical but realistic about what the near term, the intermediate term looks like for a business in terms of the returns it's likely to get. Apple may turn out to be binary. It may turn out to have something in the metaverse and with AR glasses and things like that could change things. But I don't know that I want to, commit 90, 50, 60, $90 billion to that prospect of sort of turning around the battleship in the bathtub, in the near term. So I'm a skeptic on those sorts of things. I understand why some people like it, but I oftentimes find that it masks the dilution factor, if you will, that that option granted would incur.
Mm-hmm.
Dodd, care to share any further thoughts on that? And
No, I think it's a great question, great observation. And, we got to look at buybacks at all different scenarios. And that one is, a little more controversial, but it's something we do look at a lot in other industries and look favorably on, but at a high price, that's a hard trade-off, as Peter outlined.
and yet you all are big believers in Berkshire Hathaway.
Mhm.
And nobody can question the success of that company and what it's achieved, right? But their big holding is Apple, right? I mean, what is Warren Buffett thinking in that context, right?
Well, Buffett has a couple of features to his business model that make things a little bit harder to emulate, first of all, and find exact analogs for. Okay, so for instance, his return and his earnings yield on cost at his cost in Apple leaves a lot of room for for things to happen, and basically he's locked in a cost basis that on a weighted basis looks very, very attractive relative to today's price. So he has a lot he could give back and still show a great return to the business. But it is true that he seems to be investing more and more in these sort of dividend yielding companies, right?
Mhm.
And so you'd think that he would want the dividend as much as anything else, because the dividends, whether it comes from Occidental Petroleum or the railroad, think about it this way: he is an insurance framework mindset guy, and instead of having just insurance premiums paid to you that you could then reinvest as float, it's float. Imagine that you have non-conventional sources of inflows. I mean, if Buffett were a mutual fund manager and he had, say, 5-6% inflows net per year, right, of cash, think about how much you could use that as a lever, right, as a fulcrum for making new investments, especially in times when others might be a little bit cash poor, right, or cash flow poor. So he has that business model, which if you aggregate all of the dividends that he brings in and the investment income and also the insurance and reinsurance premiums, he would be one of the most successful money managers in the world in the mutual fund industry without even having external clients, put it that way, in terms of just sort of net flows and growth. It's an interesting model. It's very very hard to put yourself in that position and say we're going to replicate that, per se, because structurally it's just almost prohibitive.
Yeah, I mean, I guess one can comfortably say that he's got a better balance sheet than the U.S. government these days.
Yes,
For
yes.
sure.
And would you expect him to actually prefer for Apple to raise their dividend? And maybe we're going off subject here because nobody really knows or can anticipate what Warren Buffett's really going to be thinking. But I am surprised that that's not where Apple is tilting more than the buyback. But that's just my view on it.
Yeah, I'll just say one last thing. It presumes, however, what you're saying, it presumes that one can get a return elsewhere other than in Apple, right? That would match Apple's return on investment, discounted a bit for the premium you're paying, right, for the stock in the near term. So Buffett may be in favor of the buyback in the sense that relative to his earnings growth rates, it's very difficult, given his size, to imagine putting a lot of capital to work at, say, 20+% ROE. Be very, very difficult. If he had operating businesses that could do that, then maybe Apple would become a little bit more of a tempered bet.
Yeah, so let's tilt back to Davis and speak a little bit about how Davis has managed through different cycles, and your strategy, in my mind, is more GARP than growth or value. I mean, I think that's fair to say.
Yeah.
And how have you done? How have you managed different cycles?
Well, I think this is an interesting time to sort of, I think, explore and expand upon the way we have structurally done it positioning wise in the past. Usually what happens is the cycles that sort of rotate, I mean, capital rotates in different groups over, 1, 2, 3 years at a time often. The 90s were an excellent case study, because rather than going for broke in terms of chasing high valuation momentum stocks, I'll tell you the way we created the most value in the 90s, starting with 93, 94. In 93, we rotated very heavily into financial stocks. Now, this is sort of towards the tail end of the S&L crisis. It's around the time of the Resolution Trust Corporation. And the economy by 1994 was beginning to show sort of green shoots. So we had a broad-based view that coming out of one of the worst banking disasters and broad-based banking disasters in history, that there would be some companies that would sort of rise from the ashes. And you even had companies that were relatively healthy. You take Wells Fargo, for example. They were forced by the regulators and the powers that be to call certain things non-performing. So they had a bucket called performing non-performing assets. And it was basically non-performing assets that were doing just fine. But there was such a deep knife sort of put into the definitions of how you had to categorize things at the time, that and their recovery on that portfolio was almost 100%. It was amazing. So that happened. And then 94 to 96, what did we do? Well, we had two opportunities presented to us. The first was in the semiconductor world. We went through the worst semiconductor recession or depression since World War II. And so you could pick up Intel, Microsoft, Molex, you could pick up Texas Instruments, Applied Materials, and you pick up all these companies for basically a song at the time. The semiconductor businesses were really out of favor. And then they catapulted up, propelled forward for the late 1990s. But in between, you also had, interestingly, an opportunity in property casualty insurance, right? Now, why? It's because in 1994, you had the Northridge earthquake. And what happened after that was anyone who stayed in business on the insurance side jacked up their prices tremendously. And people in California and earthquake, sort of prone areas realized that they were underinsured. So you had that. And then the late 1990s was fascinating because, yes, we had some tech companies, but where we made a lot of our money, other than, say, semiconductors and some broad tech, was actually in financial services, where in asset management and in brokerage investment banking. Because during the IPOs of the dot-coms, who made the money? Well, it wasn't the sock puppet companies. It was actually the investment banks and the brokerage companies bringing them to market, right? And taking a very hefty cut of the market receptivity and the value of the capital that they raised. That was real money in the bank. That you could point to as profits. So that just shows you we had to be creative about it, but we kept pace and then some with a market. Otherwise, if you just bought and held the very, very expensive stocks, you were on a less stellar track than what we were able to produce, being cheapskates and being, sort of counter cyclical. And where it really paid off was in the year 2000, when the market went down 9% or so. It was the beginning of the tech wreck. We were up 9%. So we had a delta of 1,800 basis points of spread between our 1-year performance in the markets, all because we had that valuation discipline. And I bring us back to today and say that it's an interesting moment in time, because it does feel a bit like a redux.
And your firm has certain philosophies that come from the founders, right? Not just Chris, but his father and his grandfather. You know, they saw a lot of different cycles. And can you speak a little bit, Peter or Dodd, about how they viewed market cycles? And maybe it's parallel to what you were just saying.
Well, I mean, I think that what I took away from sort of Shelby's teachings was the fact that at all times, you know, the market is really giving you a chance to be the intelligent investor, okay, the thoughtful investor, to be the careful investor. And you know, what he told me back in the 70s, say, so during that time when the S&P and the Dow were doing nothing but going sideways and bouncing around a lot, he said people stopped talking about the S&P for a while. And the reason was because it wasn't a high hurdle to get over, to beat. And so, you know, his lesson of history to me was that, you know, the S&P is not impervious, right, to periods, even long periods of underperformance. And if you understand the sources of that underperformance, then you can avoid it to some extent. But, you know, moreover, you can start positioning against it, right? And you can sort of look at it as underweighted, weakest flanks, and as an active manager, sometimes that coincides where you're finding the most value at the time. Yeah.
Mhm.
So Dodd, I'm going to twist a little bit here because, you know, we're painting a picture that is very realistic, in my judgment. And financial advisors, many of whom you speak to, right, are caught in a reality check. You know, what are you hearing from financial advisors about the circumstances right now around risk versus return, right? Are they afraid of taking an active stance in their portfolios or investing in actively managed strategies such as yours? Because they're really taking more risk with the passive, perhaps.
Yeah, I think that there is a growing, growing openness to adding active to portfolios that were purely just passive, right? And a lot of the value add of folks using ETFs and building models was just building blocks of actively allocating passive vehicles, making decisions on growth versus value, US versus international. Do you want to do a sector fund in there that looks particularly attractive, or even a whole sector rotation? But I think that their view slowly but surely is, I think, evolving into one that's more holistic and open to using both active and passive within each asset class, or within some asset classes. Our funds are super high active share, meaning there's very little overlap with the overall benchmark, and over the short term that can create massive outperformance, massive underperformance. You can be out of sync, if you will, with the market. But at the end of the day, having two things that hold very, very different stocks in them and have very different exposures and risk profiles can actually be better together. So we are seeing more of an openness there of traditional ETF users, which, hey, not their fault, right? I mean, active ETFs really hadn't been around 6 years ago. We were amongst the first to launch active equity based on a time-tested team process, what have you. Prior to that, there really wasn't anything, right? So your choices were just passive. So it's really fulfilling to us to see people building just better portfolios as their toolbox expands, and they have vehicles that can really sync together incredibly well.
So Peter, let me tilt to you and ask the question, maybe a little bit of the hard question. Active is the opportunity. I get it. I agree with it. But what have you guys done in the last 6 months to reposition the portfolios, in these different conditions?
Well, it's a good question. I mean, the things that we've thought about primarily have been related, one, to just the durability of sort of business model margins. Okay, so we had a sense certainly that we were heading into a pretty dramatic slowdown, and certain things happen in dramatic slowdowns, economically speaking. I mean, with inflation and interest rates, we see a bit of the crowding out of consumption, right? Especially on the discretionary end. So where does that appear? It appears in advertising very quickly. It appears in consumer spend. So we had Amazon sort of have a soft holiday sale, so to speak. It shows up in corporate IT spend. Things get deferred. That would be a deceleration in cloud contracts, for example.
Mm-hmm.
So, but what it informed us of was, Meta got down to 9 times earnings. And in contrast to the benchmark, where people, every time they plow more money into Meta today, they're buying it about 20 times, okay? We were buying it at 9 times about 6 months ago, 7 months ago. Mm. And that, to me, seems like a much more palatable starting multiple. So that was probably the biggest trade we made in that direction. In the recent few quarters, we've also added to names such as Capital One Financial, which is another sort of very controversial name, I suppose, to Owens Corning, the insulation company with fiberglass, and to Tech Resources, a copper play, right? And all of these are trading at very low valuations, or were trading at very low valuations on earnings and on assets. And so the reason why you have to say to yourself, what are the structural margin characteristics when the dust settles, is because not all businesses will sort of see the resumption or the return of the money that went another way, right? Newspapers, for example. Why did we invest in Google, right, back in, I think, 2007? We had sold all of the newspaper companies to buy Google, because that was going to be the recipient of the future advertising, sort of the classified spend, for example. So those are the major buys that we've made recently. And in terms of trims, we've trimmed some at the margin. We have not had to sell things too outright, because like I said before, the valuations weren't really that far ahead of themselves in most cases. So that's the luxury too, when you realize that you can just sort of sit on your positions and let them sort of ride for a while, and you're very comfortable with the ongoing valuation sort of margin of safety. So I think we're in a comfortable position that way.
Yeah, very much so. Peter, you highlighted so many good, changes within the portfolio, and we generally, as a research entity, want to buy businesses that we can kind of hold forever, for a long time. But we also recognize that valuations can get higher, risks can change, and we're not unwilling to lighten up on positions where we feel like we're overexposed, and there's other higher return opportunities out there. So Peter, maybe you could talk a little bit of rationalization on, we lightened up on Google, right? And a lot of people ask questions on that. And the fact of the matter is, I mean, the valuations got a little rich. The risk increased with AI, and who knows that? We know we can't predict it, but it's a risk out there. We saw other great opportunities, but I don't know, maybe if you want to elaborate on that, you were more involved.
Sure. Well, I mean, we did pair the Google position to be coincidentally where it roughly is in the market, okay, but we had a heavier position. Now we've owned Google for a very long time, in different varying proportions, but the reason for this sell was really because there are these moments in history where sometimes a door gets opened slightly, and you worry sometimes that an 18-wheeler could sort of push its way through. And in the case of, like, you think about the old AOL, right? You've got mail. People used to associate AOL with the internet, right? AOL was pretty much had a lock on dial-up. I mean, they were really the connection, the interface to the internet, right? And as soon as everyone came out with DSL and other alternatives, people realized AOL is not the internet. Now, in the case of Google, they have a huge advantage in terms of big data usually has the advantage of more intelligent operations, search results, and things like that. It's more intelligent because you have more to analyze and learn from. But that's not to say that there wouldn't be a window of opportunity, an opening, if you will, for others to press into that market share, which is over 90% share. So you just have to, I think, be cautious at the margin on, how long or how assured the hegemony of this business, can be. And all we're doing is we're just hedging our bets just a little bit, in my opinion, given all the facts. But we still like the base business. We still like their market position today. And I think they have more than a fighting chance to sort of hold their own. But the distribution of the advertising dollars down the road may get spread out a little bit more than it has been in the past.
Interesting, Peter. So in this market right now, with conditions as you described having changed, are there certain sectors that you favor?
Yes, I mean, so I think we can break our portfolio down largely into 3 thematic areas right now that interest us. The first one would be high-grade financial services. Now, we are known for an expertise and long-standing interest in financial companies. It is not to say that we want to own a monolithic exposure to the whole group. I mean, if you did that this year and had all the regional banks in tow as well, you would have really suffered, right? What we're interested in financial services right now is the fact that these are some of the most cash generative businesses at low multiples that you can find, right? And very, very sturdy competitive positions in the big banks, in particular in Berkshire Hathaway and Chubb in the insurance space. And the emphasis on cash flow can't be overstated in a weakening environment, because think about what I said earlier about discretionary spending being crowded out. What is a non-discretionary spending? Well, to the average household in America, most of literally the majority of your disposable net wages and net income will go to financial service companies or through it, right? Where it's between credit cards, car payments, mortgage, insurance. Already, I mean, in some cases, people are paying over 80%, right, to financial services companies. That is a first in line, right, position to have, sort of like a first lien on income, right, on someone's income statement. And so, it may just be, may look like a little bit of a cheapskate way to get a lot of cash, and yes, it is. And we're very bullish about the long-term prospects for these businesses. So if you can buy them for under tangible book or thereabouts, on very, very healthy, well shored up balance sheets, so that if you do go through an economic, mini storm, they're prepared for it. I think these businesses, there's a reason why they've been around in some cases over 200 years. And I think there's a reason they could be around another 100 years. So, yeah.
Yeah.
So, one more question, then we're gonna pivot to Cynthia, our director of research, and she's got a couple of questions to follow up with you. In the portfolio, in the U.S. portfolio, are there any diamonds in the rough per se, that there are companies that people are asking about why you long them? They just don't seem to be performing well, and you're taking a different position, maybe a contrary position, knowing that the market eventually will recognize what you're seeing. And what are you actually seeing?
Sure. I think while it's not necessarily a one stock portfolio idea, the Owens Corning position that I talked about is very, very interesting to me. I mean, I own a home, and every once in a while you have to do repairs and renovations and things like that. You can have storms and weather related issues. So people don't realize that fiberglass is actually a non-trivial technology. And if you think about where we are now in the cycle, with residential real estate transactions sort of slowing quite a bit, there seems to be a bit of a mucking up of the pace at which things get sort of redone. Okay, and so, but the nice thing is, over time, Owens Corning with their installation, they should be in a pole position, sort of a situation where their fiberglass insulation, is more and more required, right, by essentially by energy efficiency code. Now, this is very true in Europe in particular, where they estimate probably 50, 60, 70% of all commercial buildings are under insulated relative to where they should be. So that's interesting. But here's the other thing that they can do to add value. It's they have this sort of stacked bundled product set now where you can buy sort of 4 layers or 5 layers of roofing and insulation that that all it gets all sold together at a good price point, relative to what you'd have to pay for individual SKUs. So, and one of the things they also have is they have this new innovative fiberglass-based or glass-based rebar, right? Like steel rebar. They have one that's super light, stronger, more densely formulated than steel. And it's going to be very interesting once sort of that picks up as well. The reason I bring all this up is because it's a slow build and it's a slow burn. But at some point, what they're doing now is creating value because they're innovating on product. They're creating sort of whole bundles of product that have huge implications for returns on equity over time. And yet the stock is trading for 8 times. Why? Well, you suffer in the near term because of the sluggishness, right, of the end markets. And you have to ask yourself, is that a risk I'm willing to take? And I think it's something we're very, very comfortable taking. Like we said, you could buy the S&P fully optimized 21 times, right? Or you could buy Owens Corning, which no one's talking about, at 8 times. That's vulnerable to good news and vulnerable to a better cycle. And sort of where you're buying it in the cycle. That to me seems like a very, very comfortable starting point. And I think that is a sort of a diamond in the rough.
Yeah, we've got several of those too, Peter. But I know, you'd mentioned earlier when you talked about high grade financials as being kind of a major theme of DUSA. You said there were a few others. Maybe expand a little bit on healthcare and where we're finding opportunities in tech, because I think with those 3 themes, you've really got the majority of DUSA plus a few of these diamonds in the rough, which Owens Corning is a great example, but we've got a few others too.
Yeah, so in healthcare, we have a view that if you are on the right side of the cost savings equation for the system, I mean, let's face it, GDP, as a percentage of GDP, healthcare spend today in the United States is close to 20%. Okay, and that is roughly double almost what other major developed blocks have. So I think our natural limits of what we can spend and how fast that inflation curve can go is questionable. And so what happens is you try to sweat the asset, sweat the sector, and try to find cost savings and efficiencies within it. So you take companies like Quest Diagnostics, for example, which probably I don't know about the exact sort of equipment build out, but I would say that in terms of the format of their offices, it's probably cheaper than Starbucks in many cases to a Starbucks build out. It's a very, very remunerative business and very, very cost effective versus say hospital labs. Okay, Cigna Insurance is very interesting to us because it, among other things, they and a few other managed care companies have revolutionized, right, with digitization of records and transfer of data and teledoc kind of services, compliance of medical regimes. They've transformed the industry, and I think that has huge benefits that are felt, both on the Medicare side as well as the private sector. And then, last but not least, we have a position in Viatris, which is more controversial. There's debt associated with it, but I think that being one of the few generic manufacturers out there makes sense. I mean, in 1995, when Hillary Clinton, proposed a very different healthcare system to the country, the share of generics as a percentage of overall pharmaceutical value is about 23%. Now I estimate it's close to 90%. And there are only a handful of players in there. So that's healthcare. And then, like I said, in technology, like Dodd said, in technology, we have interest in e-commerce. We have interest in online search and advertising. We definitely have interest in social media and advertising. And finally, we have a sluggish group, reminds me of times past, in the semiconductor area, which could very well heat up at some point soon. We'll see.
So let's bring Cynthia up, and she's got a couple of questions. Thanks, Cynthia, for waiting.
Hey guys, great conversation. I'll make a quick comment because I know we're coming up on top of the hour, but your Wisdom Wednesday today is a great Peter Lynch quote that talks about how nobody can predict markets better than gizzard squeezers during Roman Empire times, which is, it's a beautiful statement about the folly of predicting markets, which I think is what active managers get associated with all the time. Somehow you guys are going to be ahead of the curve and deliver that outperformance that an index couldn't do because you know something, or you figure something else out that just owning the market doesn't allow for. But in truth, I mean, this whole conversation is just such a beautiful testament to the value of process in active management. It's all about the process and in the investment philosophy of the active manager that you invest with. I'm curious about, just the idea of value and quality. So if the secret to success is attractive valuations of quality businesses as just an overarching theme, we were just at an ETF conference last week, and that's pretty much a prevailing call right now. Find good value, but quality businesses, because, is it recession, earnings troubles, all this, trouble ahead. Is the opportunity here the fact that nobody seems to define value and quality the same way? So it gives, opens up different ways to evaluate businesses, which then makes active manager due diligence super important? Or is there something else? How do you add value as an active manager when there is such a prevailing call of finding value of quality businesses? Is there, it's going to sound like a silly question, but is there a chance of this becoming the crowded trade where everybody chasing the undervalued companies that have, good fundamentals? How do you navigate this kind of prevailing call?
I'll let Peter go through most of this, but I just wanted to, throw out there that defining value and quality is something I think really, really difficult to do in a stock screen. There is qualitative things that you can discern through knowing management teams, through company visits, understanding their customers, all of those things. And, when you look at a value index or quality index, Cynthia, you're absolutely right. There's no real right way to define it. You look at large cap value indexes, big ones that ETFs are based upon, and you see, multiple differences ranging from 18 times to 10 times, and everything in between. And they're both, labeled as trying to get towards quality, trying to get towards value. So, that's all I'll say there. I know Peter can really expand on our process and kind of secret sauce and in investment discipline, but it goes far beyond just kind of looking at the general metrics and feeling like, I've got it. And I think the other secret sauce for us is time arbitrage and being able to take advantage of things, taking a long-term view as opposed to what's right here and now at the hood. We're looking way down the road.
Yeah, I would agree with those comments, Dodd. The quality question, how you define it should correspond with and be consistent with your holding period. For example, one of the first questions I ask managers is, what's your turnover rate? And the reason is because they can say, and a lot of people will say, we're like Warren Buffett. We own things for a very long period of time. And then I look at the industry data and I ask the managers, what's your turnover rate for the last 3 years? And if it's 30 to 50%, then it's hard to make that argument, right? It's hard to make that truth case. But quality for us is, basically having businesses that do the work for you throughout a cycle. Okay, so they're not always in fashion, they're not always in favor, they're not always sort of running on full cylinders, but they're going to hopefully get you in a fairly high confidence way to a destination of a return, a compound return that is above inflation, above the risk-free by a meaningful stretch, so that it rewards you for being equities. But I think the time arbitrage one is very important, especially at this moment in time. This fear of missing out, this roving speculation bubble that keeps just sort of shining a light on different areas of the market and then sort of creating the illusion of value, right? People don't want to necessarily be out of step with the market, right? They want to outperform at all times or perform at all times. But time arbitrage is something where you have massive advantages if you have a funding model and a business model and a mindset that allows you to take advantage of it. Okay. I personally love the fact that certain times, things fall apart in the market, because then like the quality screens go crazy. The question about sort of where we should invest becomes an open question. If you really stick to your knitting and stick to companies that have a high sort of degree of recurring sort of economics, right, return on invested capital, that is your internal reinvestment rate. And that really is the key. Getting that right times the valuation, starting valuation, and then looking at time arbitrage to say, am I willing to be wrong or seen wrong for a year, right, for the benefit of a much better return potential or much better risk profile? And that's how we run our business. One of the reasons why we were private and not publicly traded too, so that we do not have undue pressures for short-term maneuvering. Okay, we want businesses to sort of season their results over time.
Yeah, I love that. I'll let you take it over, Weisskopf, but I love that you gotta be private in order to to be able to sit on a tough position, which is so true. It's so true. So thanks so much. That was great.
Yeah, no, we're unique. I mean, it's almost, we have a lot of skin in the game with family foundation, firm money there, in that, it aligns us. It allows us to make the best decision long term as opposed to short term. And we all be kidding ourselves if we didn't say we are in a high pressure business, and as a portfolio manager at public firms, it's sort of, what have you done for me lately? And there is immense pressure to not go too far off of that benchmark, because you may not be around next quarter if you have a bad one, even though you might have made a great decision for a 5 or 10 year investment. So we have that luxury, and we eat our own cooking, and I think that is something very differentiated.
Dodd, you touch on a lot of important aspects about the firm's culture, and one of the key components goes back to your history of your founders, giving back, right? And in the ETF think tank, we always talk about that too. Can you talk a little bit about the United World College? It's in the link in the chat, or a link is there for anybody to explore further about the charity, but you guys are big supporters of it.
Yeah, I'm going to let Peter talk about that. And Peter, maybe you lead with the quote that Shelby said about whatever the 3 stages.
Mm-hmm. Yeah, sure. So, one of the pearls of wisdom that I picked up from working with Shelby is that, he was very philosophical about and very long into the future, sort of almost a futurist visionary in terms of what the world could become. And so he said that in his family, the first 30 years are of your life you're meant to learn. The next 30 years of your life, you should try to earn. And then if you're in a fortunate enough position by the end, the last 30 years, you should return, right? You should return. And so it's sort of a full life cycle view of your productivity and your contributions to sort of, causes. So the United World College started out sort of a fledgling group of set of scholarships, where the college itself is I believe it's a two-year program, second half of high school, basically. It brings together kids from probably well over 100 countries, and I believe they have now over 10 or so, maybe many more than that, campuses around the world. But they started out with a campus in Las Vegas, New Mexico, and there, what they would do is they would educate people, but also give them a real experience with the other. Okay, if I can call it that, right? So the Israelis and the Palestinians oftentimes would be bunked together. And the idea simply is that at some point in the future, they may be staring at each other through a lens or a sight of a gun. And if there's a chance for us to diffuse the future, then you have to start sort of understanding integration, having open-mindedness and compassion, right? Universalist view of humanity. You have to have that in place or infused in the future. And I think that's kind of the beauty of the scholarship. But now, I mean, there are well over, I mean, there are dozens of colleges that if they accept you out of United World College, you can get partially paid tuition and room and board, or full boat. And it's very, very exciting, because I met a lot of the students from there, and they're impressive. I mean, they're very, very impressive human beings to have that world experience. Yeah.
I love on their website, they got a quote that says, "Education is our greatest weapon to change the world." And it is. It's about bringing people together from very, very different backgrounds, very different value systems, and bring some of the greatest minds together to share and understand and see things through each other's eyes, and that's really important today.
Well, Dodd, thank you. Peter, thank you. This is a perfect place to end. Let's all hope for better markets, or at least be smarter investors. I think that's really important. And thank you for your support in the ETF think tank as well, of course.
Of course.
Have a good day.
Thanks, Dan. Thanks, everyone.
Thanks.
Bye-bye.